Imagine that you were a contestant on Who Wants to Be a Millionaire, and you were left with two choices: to leave with $500,000 or continue for $1 million. But if the question is answered wrongly, you leave with not a single penny in hand. Which would you pick? Well, are you willing to engage in high risk activities for a larger exchange? Or do you want to grow your money with little to no risk at all? Welcome to Stocks and Bonds. Typically, stocks are for growth, while bonds are for preserving what you have. First, there are stocks. Yes, I know the first thing in your mind when I say stocks is Leonardo DiCaprio on The Wolf of Wall Street, or instant cash, but let's get that out of the way and learn about real stock. Stocks are actually shares of ownership in a corporation. Once one invests or buys stocks, he becomes a shareholder or part owner of that specific business. Can one buy stocks of McDonald's, for example? Should we order over the counter for stocks? Nope. We buy stock at the stock market, of course. This is a place where stocks are bought and sold. An example is the New York Stock Exchange, the Tokyo Stock Exchange, and the like. To buy, you can look for a trusted broker. Otherwise, they can be bought through banks, insurance companies, and online brokers. Open and fund an account, and you study the companies meticulously. Now, people buy stocks because of the reason of their wish to benefit from a company's tremendous value potential over time. They gain through 1. Stock price appreciation, or the rise in the market price of your stock over time, and earning dividends, a distribution of the company's earnings to its shareholders from their net profit. Most are paid by cash, and others in stock dividends, although ownership percentage will not rise as all stockholders receive the same amount. Simply, it's like this. Let's say I bought stocks from Chipotle. Does that mean I get endless amount of guac? No, that's not what stocks are here once again. When stocks are bought, it means we are a part shareholder of this company. If Chipotle earns, then the shareholders, including me, also earn through their profits. These are called dividends. Fun fact, back in the days, there were actually paper stock certificates. It is a document that evidences the ownership of the security or financial instrument. Moving on, now there is a medium used to denote trends in the securities market called market index. These are intended to represent an entire stock market and thus track the market's changes over time. Examples would be Nasdaq, Dow Jones, and the NYSE. Now in stocks, there are two kinds of market: the bear market and the bull market. A bull market is characterized by an increasing market, a market on the rise that will ensure investors at times that the trend will continue long term. It is also a sign of the country's strong economy and high levels of employment. Meanwhile, there is the bear market, that the trends are decreasing and other investors will believe that such will continue for a long time. Economy typically slows down and companies will begin to lay off workers, causing a high unemployment rate. These terms are based by their way of attacking. A bear attacks by swiping down and a bull attacks by swiping up. Meanwhile, there's also the fury of efficient market, wherein the information an investor knows about a stock is available to other investors, meaning he cannot beat the market since everything has been reflected within the known information. They can only beat the market by inside knowledge and luck. Proponents of this theory simply try to match the market's performance. Overall, when one chooses to invest in stocks, remember to invest early, regularly, long-term, and invest using diversification. How about a bond? What's a bond? No, not that bond. A bond is a loan or debt instrument. It is issued for a period of time with the purpose of raising capital by borrowing. Here, a bondholder lends money to the bond issuer. Now, other terms to remember are the coupon rate, or the annual interest rate paid by the bond issuer, the maturity date, or when the loan ends and the bond issuer pays the principal to the bondholder, and the par value, the amount of principal that must be repaid to the bondholder, a dollar amount assigned to a security when first issued. One must remember that bond prices are not coded in dollars, but as a percent of par. So, let's practice by an example. With an 8% annual interest rate, ABC borrowed $150 from Cindy. The bond issuer is ABC. The bond holder is Cindy. The par value or principal is $150. The coupon rate is 8%. The annual interest can be computed by multiplying the par value with the coupon rate, which is $12. Every 6 months, half of the annual interest rate must be repaid to the bondholder. So, it would be $6 in this case. So, the last payment consists of the principal amount plus the last interest payment, aka $150 plus $6 to be repaid at the end. So, let's organize what stocks and bonds are. In stocks, you own shares in the company through the former. In bonds, it is a loan instrument. Here, we benefit from the growth of the company, and on the other side, we benefit from the interest amounts paid for the loan. In stocks, profits are paid via dividends. In bonds, it is made through the form of coupon payments. A major difference is that in stocks, money grows faster if the company's performance is better. And in bonds, holders only receive a fixed payment regardless of how the company does. Although, being a bondholder is much safer than being a stockholder. If a company liquidates, it must pay bondholders before the latter. So, out of all of these, where do you prefer to invest your money? Stocks or bonds? Some concepts may be perceived as easy, but there are quite a number of unexpected risks that may come at any time. Although that's what the stock market is for. The higher the risk, the higher the profit, or the higher the money lost. So, would you rather stay safe with bonds and earn steadily, or take your chance? Knowing the basic concepts of investing money is very significant, and being educated about these things at an early age can help anyone as they grow or start thinking about their future to be stable. Like investing, learn early. This knowledge may serve to help you more than you could ever imagine.